demand for U.S. Treasuries declines like it did last week, that means increased borrowing costs, both for the government who issues the Treasuries, but also for ordinary Americans, like in the form of mortgages. And it's not like this was driven by some Fed decision. In fact, it was the global financial system basically reacting to new economic conditions. Although it's too early to know if this is going to last, it does concern me because there is now the prospect that mortgage rates are going to stay higher even if we go into an economic downturn. And that is not what normally happens. Normally, if the economy is struggling, mortgage rates go down and that boosts demand for housing and helps lift the entire economy out of a potential recession. But if this continues, we may not see that decline in mortgage rates, even if we go into a recession. And that would be trouble for the housing market. So I know this is nerdy, but this is something you really need to keep an eye on.
Now, I do love the Data Deli, and he has some really great points, and I will tell you what he left out is the talks about tariffs. Now, this is causing some real market uncertainty, and everything is trading off of headlines. So when we have negotiations, when we have some solutions to this marketplace and tariffs, this is going to bring mortgage rates down. Now, the good news is we have lower inflation overall, and that is truly the driver of mortgage interest rates. So stay tuned, pay attention to tariffs, and pay attention to any sort of negotiations. That's where it's at.